Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Fih Mobile Limited annual report. Fih Mobile Limited offers a diverse range of services and products to the global market. At its core, the company provides integrated manufacturing services for the handset industry worldwide. This includes designing, manufacturing, trading in, and repairing handsets. In addition to these core services, Fih Mobile Limited also offers various specialized services such as mobile/IoT devices, smart manufacturing services, intelligent automotive solutions, software engineering, and vertical solutions. These services cater to a wide range of industries and applications, showcasing the company's versatility and expertise. Furthermore, the company is involved in research and development activities, which enables it to stay at the forefront of technological advancements. It also engages in the manufacture and sale of electronic products, as well as import and export activities, solidifying its position as a comprehensive provider of services and solutions. The recent surge in Fih Mobile Limited's stock price can be attributed to a series of positive news events that have taken place over the past year. One key factor has been the company's return to profitability, with a profit of $42.09 million reported for the first 9 months of 2025. This financial turnaround was further reinforced by the announcement of a proposed final dividend for 2025, which signals management's confidence in the company's financial health. The inclusion of Fih Mobile in the Southbound Stock Connect list has also contributed to the stock price increase, making it more accessible to mainland Chinese investors and potentially attracting new capital. Additionally, the company's strategic investment in Vietnam, valued at $35.8 million, suggests expansion into new markets or manufacturing capabilities, which could drive future growth. Furthermore, Fih Mobile's share consolidation and buyback plans have also had a positive impact on the stock price. The 10-for-1 share consolidation aims to simplify the company's capital structure, while the equity buyback plans aim to return capital to shareholders and potentially boost the stock price by reducing the number of outstanding shares. Overall, these corporate actions and positive financial results appear to be the primary drivers behind Fih Mobile's substantial increase in stock price over the last year. Fih Mobile Limited market capitalization of $16 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Fih Mobile Limited holds a significant advantage in their industry. Fih Mobile Limited trades at a higher price-to-earnings ratio of 124 times and a higher price-to-book ratio of 1.41 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 62% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count, reflecting a shareholder-friendly approach to capital allocation. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the extracted summaries. On the growth side, several factors contribute to an increase in revenue. Firstly, geographical expansion plays a significant role, with Asia segment revenue increasing by 9% due to various factors. Additionally, the company's shift towards higher margin sectors, such as automotive electronics and smart manufacturing, has led to increased shipments and revenue growth. The investment in AI technology and lower interest rates have also positively impacted revenue growth. Furthermore, the company's diversification beyond smartphones has broadened its customer base and product portfolio, leading to strategic transitions to higher margin sectors. The accelerated shipments by customers in response to possible U.S. tariff increases and the 90-day pause on smartphone tariffs have also contributed to revenue growth. On the other hand, several factors contribute to a decline in revenue. Firstly, the termination of low-margin domestic businesses in China and India has led to reduced shipment volumes and sales. The implementation of the DPDP Act in India has also had a negative impact on revenue. Intensified market competition, surplus production capacity, pricing pressure, memory supply constraints, component shortages, product cycle adjustments, extended phone replacement cycles, aggressive price competition from peers, margin compression, customer insourcing, and reallocation of orders have all contributed to a decline in revenue. Furthermore, the potential decline due to exit from unprofitable or low-margin businesses and site consolidation may involve non-recurring costs and operational transition risks. Overall, the primary drivers of revenue growth or decline are complex and multifaceted, involving various geographical, technological, and market-related factors. The net income of the company underwent a significant transformation between 2024 and 2025. Initially, in 2024, the company incurred a loss of $20.3 million. However, this trend reversed in 2025 with a profit of $52.7 million, marking an improvement of $72.9 million. The net income continued to increase in subsequent years, reaching $205.2 million by 2026, representing a growth of $70.6 million from the previous year. Furthermore, the company's net income also increased by $54 million in another period, and by $4.8 million in yet another period. In contrast, the profit margins experienced fluctuations during this period. Initially, they improved from 2.36% to 3.08%, indicating a positive trend. However, this improvement was short-lived as the profit margins compressed by 10–15% due to intensified market competition and other factors. Despite these challenges, the company's profit margins showed signs of recovery in certain periods. For instance, they improved slightly due to the termination of low-margin businesses. Nevertheless, the overall trend suggests that the company faced significant headwinds in maintaining its profit margins during this period. The question of whether the company is generating positive or negative operating cash flow has been a subject of conflicting information. On one hand, page 32 suggests that the company is experiencing difficulties in generating sufficient cash from its operations, with a net cash from operating activities of $108 million and free cash flow of -$79 million outflows. This implies that the company's expenses are exceeding its revenues, resulting in a negative operating cash flow. However, on the other hand, pages 13, 22, 33, and 40 present a different picture, stating that the company is indeed generating positive operating cash flow. This inconsistency raises questions about the accuracy of the information provided. It is unclear which statement is correct, or if there are any mitigating factors that could explain the discrepancy. Ultimately, without further clarification or context, it is difficult to determine whether the company is truly generating positive or negative operating cash flow. However, based on the conflicting information presented, it appears that there may be some discrepancies in the data provided. The company's financial performance has shown a significant improvement in its debt level and interest expenses. The interest expenses have decreased by 56.9% from $57,633 in 2024 to $24,784 in 2025, resulting in a substantial reduction of US $32.8 million. This decline is attributed to the decrease in interest rates and the relocation of funds to repay loans. The company's debt level has also undergone a significant change, with bank borrowings decreasing from $341,420 to $108,370. The overall debt level has decreased significantly from $341 million to $108 million, indicating a substantial reduction in the company's financial obligations. These changes suggest that the company is taking steps to manage its finances effectively and reduce its debt burden. The company's performance varied across different regions and segments in the recent period. Notably, Asia and America were standout performers, with revenue increases of 9% and 22%, respectively. Segment profit also saw significant growth in these regions, rising by 12% and 59%. In contrast, Europe struggled, experiencing a substantial decline in revenue of 65%. The company's other segments, including automotive electronics, manufacturing equipment, robotics, on-site support services, and fixtures manufacturing, also performed well, contributing to the overall positive results. These areas demonstrated resilience and growth, underscoring their importance to the company's success. Management's outlook on the company is one of cautious optimism. Despite the persistent macroeconomic uncertainty in 2026, the company remains committed to its growth strategy, which has seen over 20% year-on-year growth. To maintain its competitive edge, the company is investing in digital transformation processes, including smart manufacturing powered by AI, robotics, and IoT. The company's solutions have been performing well, with a focus on long-term strategic purposes through equity investments. Management continues to explore opportunities for business development through strategic investments, aiming to enhance long-term competitiveness and technological capabilities. To reduce bank loans and lower interest expenses, the company will increase engagement in global cash management by repatriating funds from subsidiaries to the parent company. Management is also aware of the global minimum top-up tax under Pillar 2 rules, which will be applicable from fiscal year 2025 onwards. However, this has not deterred the company's growth plans, as it continues to employ natural hedging techniques and financial methods to manage foreign currency exposures. Overall, management's strategy is centered around maintaining a competitive edge through innovation and cost management, while navigating the challenges of the global economic landscape. The company's financial activities have been marked by several notable transactions. Firstly, the company has demonstrated its commitment to returning value to shareholders through dividend payments. This is evident from the declaration of dividends and the subsequent payment of a significant amount, totaling $27.1 million. In addition to paying dividends, the company has also engaged in share buybacks. Specifically, it has purchased treasury shares, currently holding 8,181,814 such shares. This strategic move allows the company to manage its capital structure and potentially enhance shareholder value through increased ownership. Concerns about inventory buildup or supply chain disruption are evident throughout the industry. The rapid expansion of AI has driven shortages of key components, such as DRAM and NAND/SSD, which is expected to continue into 2025 with severe shortages predicted. The decline in customer demand due to market saturation has exacerbated these issues, leading to a 200% price increase for certain chips. Geopolitical events have also contributed to trade restrictions and tariffs, further disrupting supply chains. As a result, prices are forecasted to rise by 40–50%. Supply chain disruption is not only a concern but a reality, with geopolitical complexity, realignments, and shortages of memories causing significant issues. Component constraints have affected new generation products, and procurement and budgets have been tightened due to weaker end-market demand. The industry is bracing for severe DRAM and NAND shortages in 2025, which will likely lead to further supply chain disruptions. Geopolitical tensions and trade barriers are also expected to continue causing problems, making it essential for companies to adapt and find solutions to mitigate these risks. That concludes the financial summary for Fih Mobile Limited. Feel free to comment below, and I will be happy to answer them when possible.